Let's just get started. I'm gonna introduce you guys, tell everybody who you are. So today we are joined by Zach Eisenberg and Zach Krasko. Zach and Casey are long-term team members at Greenberg Advisors, an investment bank specializing in revenue cycle management and healthcare technologies and M&A transactions. Zach is a managing director and brings over a decade of M&A experience. He oversees a majority of Greenberg Advisors engagements and has advised many different RCM and healthcare IT firms that are either looking to sell or buy other companies throughout his career. Casey is a senior associate with the firm and has 8 years of M&A experience. His role at Greenberg Advisors includes analysis, modeling, and managing the M&A process for many of Greenberg's engagements. Thank you guys so much for being here. I'm excited to talk about this. So just to give you guys a little bit of a background for all those people that are joining in, some of you have been on the medical billing company owner mastermind webinars. I know that's a mouthful. And we were doing these webinars every single month for many months, and it was really great. And then we decided to move to the podcast. We called it Leaders in Medical Billing, and we've been podcasting for a while now. The reason why we decided to bring the webinar back is because we realized that there's a lot of loneliness in our industry and people want to feel connected. And so we are bringing the webinars back. They're now called Leaders in Medical Billing webinars. And this came by through a conversation, Zach, that you and I were having when we were podcasting together. And you were talking about profitability. And I said, well, could you just do a webinar about this? And let's make sure that everyone understands how to do this. And what did you say?
Absolutely.
Awesome. So we're here. That's how things happen around here. We just talk about something, we see a problem, and we just go ahead and provide it. So I'm going to hand this over to you guys. And just for those of you that are joining, we have these webinars happening. We're going to try to do it once a month. Look out for emails. We're going to have one on marketing with Brian Crush. We're going to have one with Dave Giachello. So we have a few of them already lined up. This is our first one. So Zach, take it away.
We're excited to be your guinea pigs. And seriously, thank you for having me back. I really enjoyed our conversation and hope this one is just as successful.
I know it will be.
Okay, hopefully everyone can see Casey's screen there. So Case, why don't we hop into it?
Yeah.
Okay. So I don't want to detract from the very fun topic at hand of profitability by clients. So I'll just spend a few seconds here just educating you all on our background to the degree you're not familiar with our firm. So we are Greenberg Advisors. I'm a managing director. Casey is a senior associate with the firm. And we are laser focused on revenue cycle management in healthcare IT. We advised on 10 transactions last year, many of which involved billing companies, but they spanned the entire healthcare ecosystem. So we do primarily buy-side and sell-side M&A, so helping owners who are looking to sell their business and buyers who are looking to acquire other companies. We also help owners with M&A strategy and planning, and we do valuation and capital raise work. So why don't we start off with some engagement? Chanie, do you wanna launch the first poll for our audience?
Yes. The first question is.
Oh, here I am clicking.
Okay.
Right,
Do you guys?
so
Does
the
everyone
first
see the
question-
poll?
Yeah. Have you performed a client profitability assessment? Single choice, yes or no. So if you would please make your selection there. How are we doing so far?
Cool. It looks like we have 60% has done it and 45% has not done it.
I might have to check your math there.
No,
But
as
no, that
people as people keep responding, it changes. Now
okay.
it's 55, 40, 55, yes, 45, no. So,
Interesting. Okay.
yeah.
Okay. Well, look, for those of you that have, for those of you that have not, we hope that you all find this to be a worthwhile presentation. Understanding this is an important, thanks, Case. Understanding this is an important exercise. So I thought it'd be helpful to have Casey join, and he'll actually lead the majority of the conversation. And Casey is just really surgical with the numbers. So overall, I think one of the things that differentiates us, GA as a firm, is our ability to really get in there and know our clients' businesses inside and out. So this is one of the common exercises we'll do with clients, some of which have attempted to do this in the past, others who have not. But the goal here is really to share with our audience some of the methodologies and tips and tricks that we've learned along the way. So you might be wondering, how does this come up? And there are a few ways it comes up. One, we're marketing your business, i.e. selling it. So this is actually one of the analyses that we'll do on the front end, just to understand profitability distribution. And then another way is maybe you've been approached by a buyer. This is absolutely one of the events that will likely come up during the due diligence process. And maybe let's go to our next poll here. Have you ever been involved in an M&A transaction? Let's see if we can get to 100.
Okay, we have 78% no, 22% yes.
Okay. So I wonder, and we don't have a follow-up poll, but I wonder of those 22%, how many actually went through this exercise as part of due diligence? But either way, those are two common ways that they can come up. Either, like I said, either we're marketing or selling the business and representing you, or you've already been approached by a strategic or financial acquirer, and this is one of the due diligence exercises. But it can also just be an act of self-discovery. I want to learn more about my business. So those are kind of the ways it can come up, but why it's important. It can show you which clients are boosting or decreasing profitability. It's not always the case that there's a one-to-one correlation between revenue and profitability, meaning just because your top client might be generating the most amount of revenue, it might not be contributing the most amount of profit. And similarly, it's not always a given that all clients are profitable. So as bullet point 2 says here, it can be illuminating. It shows an honest assessment of the client's impact on your business. It can also be helpful, as is common in the RCM and billing industry, in terms of rebids. If you know that a client is already negative margin and they ask you to cut your rates, well, then you've got a business decision to make. But at least you have this information at hand as you contemplate that decision. And last, but maybe certainly not least, maybe it can be replicated, right? Like if you're looking at client 2 and they're insanely profitable, maybe you can do some analysis and understand, okay, why are they profitable? Can we mirror that with other clients and boost the overall profitability? So they're just some of the business reasons on why it's important, but from an overall transaction perspective, it's also very important. First and foremost, it can impact deal terms. If it turns out that you as a seller have a significant profitability concentration, meaning one client or two clients constitute just an overwhelming majority of profitability, it can actually lead to less favorable deal terms as a seller, because it presents more risk to the buyer. So that might translate to less cash at closing, more money on the back end. But conversely, if we're able to show more of a widely distributed profitability, meaning profitability is spread out evenly across clients, then we can leverage that to negotiate more favorable deal terms as a seller, right? We can get more cash at closing, we can get higher enterprise value and so forth. And then the other thing is, and this is super important, it just builds credibility with the buyer when they, when they ask for this exercise and you have it handy and you know it inside and out, it just gives you that credibility that you can leverage throughout the entire M&A process. And then lastly, if it's something that we've done ahead of time, we can see if there are tweaks we can make to spread profitability out amongst the clients. So next, I'm going to turn it over to Casey, and he'll walk through the various methodologies that we've used and different approaches to this exercise. We've got about 20 minutes or so of content, and then we're happy to leave it open for Q&A. Again, understanding that a lot of the audience has not gone through this exercise. We're happy to answer any questions you have.
All right, so thanks everyone for joining. So we're going to hop into the modeling, and before we do that, we want to lay out a couple of pointers that over the years we've found help in not only making a successful client profitability analysis, but also maintaining one in the future. We should probably define what our goal is. So our goal is to create a model that provides an accurate representation of how much of your profitability is coming from each client. So that's the end result that we want. We hope along the way through the exercises that you have to do to get to that final goal, you will glean insights from other parts of your business, and the process is enlightening. But as far as the model itself goes, I think the goal and what makes this successful and continuously successful is creating a model that is as simple as it can be and easy to update. If you do those two things, you're more likely to do it in the future. If it takes you 10 hours to update your file, it's more likely to get pushed off every month or every quarter, right? So we want something that's approachable and easy to update. So how do we do that? We've got 3 simple rules here. Keep it simple where we can. If we're looking at an expense that's $1,000 a year and your business is $5 million in revenue, you shouldn't spend more than a few seconds on that $1,000 because it's not that impactful. Use simple rules for small expenses and dig in on the major line items. Sanity checks, do them early and often. So whenever you're modeling something with a high level of detail, it's really, really easy to get in the weeds and lose track of where you are in the process. And you end up with numbers at the end that you just don't feel like they represent the reality of the situation. So as you go through, check your outputs, make sure they're passing some level of a litmus test. You don't want to skew your model to just say what you want it to say, but if things jump out at you as looking just completely wrong, you want to catch that earlier on. And then lastly, perfect is the enemy of done. There is no such thing as a perfect client profitability analysis because we're all people. We don't come in and do the same exact thing every day, work for the same client every day. There's fluctuations in what we do. So just keep your mind on the goal. We want something that's reasonably accurate, reliable, and easy to update. It should illuminate to you who are the more profitable clients and where they sit, who are the less profitable clients, and some areas that you can improve. But you shouldn't be ticking and tying every single dollar because it'll never end, basically. So let's get into an example. So we've created a very simple P&L. Like most billing companies, payroll and benefits are the overwhelming majority of expenses. So I think as we go through these slides, I want you to understand the methodology and the concepts, not so much a specific definition for each line item. If you understand why we're making the decisions we make and how we're getting to that conclusion, you'll be able to take this and apply it to your own practice. So the first step is we need to go through our expenses and figure out how are we going to allocate these expenses in as in what's our type of allocation and then the method for the allocation. So you can see we have 3 different types of allocation. One is direct, one's indirect, and then payroll and benefits, we have a mix of the 2. So our direct expenses can be tied to us delivering a service to our client. Our offshore vendor, our postage and delivery, clearinghouse expenses, things of that nature. If you didn't have those functions, you could not do billing, right? So they are directly tied to delivering your offering to your client. Our indirect expenses are more so our corporate overhead or things that are very, very, very difficult to allocate to any specific client. So, legal and accounting, right? You don't really need those to do billing for your client, but you do need them to stay in business. So, how do we allocate those? We allocate them as an indirect expense. Okay, so the next step here, and then we'll go through these different methods as we go through the slide. So I'm not going to define them here, but we will circle back. So we're setting up our spreadsheet further. The next step would be to bring our clients in. For this example, we've created 5 clients, clients A through E. And right here, you can see how much revenue each client's contributing, ranging from $1 million, this is in thousands, so $1 million all the way down to $100,000. And then right below it is what's their overall percentage of revenue. Client A is generating 33% of our $3 million. Okay, so we have our template set up. So the first thing we would suggest to do as we look at our expenses and we start to spread them out from client to client is start with the easiest one. For us, we think the easiest expenses to allocate are the ones where you are basing it on revenue. So it's a very simple formula. I know there's some lines and highlighting, but the highlighted numbers are the ones we just populated. They're all based on revenue. And what we're doing is we're simply saying that client A is 33% of our total revenue. So we're going to allocate 33% of this software expense to client A. So it's just 75 times 33%, and that gives us our 25. And we do the same for each client for software. And then we also do the same for all of these different expenses. Very straightforward, very simple allocation for this type of treatment. The next one, we're going to look at a couple of different, more specific allocations. So we have examples for the offshore vendor and the clearinghouse. For these, we'll do one with actual usage, which is the offshore vendor. And then for the clearinghouse, we'll use claim volume as a proxy. So let's go to the next slide. Just to help you focus, let's start just with the top table right here. This is our offshore vendor cost. So let's pretend that we use an offshore vendor to do coding and data entry. For our coding, they charge $1.80 per record. And for data entry, they charge us $2,000 per FTE. We happen to have a very nice reporting friendly offshore vendor that's able to break out our cost by the client. So they coded 40,000 records for client A. They coded 17,500 for client B. Client C doesn't allow offshore coding, so they didn't get any. And then here's our cost. So it's $1.80 per record. And basically, we're just taking this cost, which we know from the invoice, and spreading it based on the volumes that the offshore vendor handled for us. So this is, I think, conceptually a pretty straightforward exercise if you're able to get this level of detail. It's the same exact thing for our data entry FTEs. But instead of per record, they're charging us per FTE, and we have an FTE rate of $2,000. So 6.4 times 2,000 gets us here. And then our total offshore costs, this is the number that we'll use to plug into our P&L model, is just a sum of these two. So I think conceptually, most people would understand, okay, if we have the invoice that breaks it out by client, very easy to associate those expenses with the client. Now let's pretend our clearinghouse vendor's a little less friendly, and they don't break out the claim processing by client. So then we're stuck in a situation where we have $75,000 in clearinghouse expenses, And we're asking, how can we allocate this by client so we can determine our client's profitability? What we've often found is total claim volume is a really good proxy. One, it's an easy report to run by client. Usually most PM and EHRs allow you to run that report, and you can easily pull it on whatever frequency you want to update this for. Two, most billing companies will process the majority or at least the same amount of claims for each client and send them all to a clearinghouse, right? So total claim volume might not be 100% accurate, but it's usually more than 95% accurate, which is sufficient. So client A represents 35% of the total claims we received for 2022. Client B is 23%, client C is 18%. So we just take the 75,000 and we split it up according to these percentages. And that's how we're going to allocate our clearinghouse costs. You might find that there's different metrics other than claim volume that you think is better suited for your business. Again, we want you to understand the concept. So if you have a better metric that you think more accurately allocates a cost for any use, use that. But this is really conceptually just showing this is how we often do it. So we'll take these numbers. So this, once we put it into thousands, will be 85,000, 42,000 for client B. For client A down here, 26,000. And you'll see those pop up in our P&L here, 85,000, 42. We skipped postage and delivery. It's the same concept, but we figured 2 examples was enough. And then clearinghouse, 26,000 for A, 17,000 for B, and so on and so forth. So that's a couple of the common ways to allocate expenses for different line items on your P&L. But our biggest item is payroll and benefits. And this is usually by far the most complicated part of the analysis, most time intensive, but also the most important, because as you can see, it makes up 1.8 of our 2.5 million in expenses. So don't get overwhelmed by the page. I know it's a lot of numbers. It's very detailed, but we'll start from the left and we'll walk through slowly. So first column is simply employee numbers. So we have something to reference. The next one is our employee titles. And then we get to loaded compensation. So loaded compensation is just a term that we use to represent what does this employee cost the business. Not necessarily just what you pay the employee, but what is the cost of the business of having that employee. So usually what that includes is you use your payroll ledger or payroll reports, and then you take the benefit costs that the business absorbs, and you just calculate a percentage. So if your payroll was $100,000 and you incurred $15,000 in benefits related expenses, that's a 15%. So 15% of your payroll, you usually incur in benefits expenses. So then we just add 15%. So if the CEO is making 225,000, and then we add a 15% benefits buffer, it brings us up to 250 something thousand, right? And that gets us our loaded comp, which is what it costs to have that person as an employee. And that's ultimately the cost that we'll be distributing across our client base. So let's shift now to the next 3 columns. So allocation type, clients, and allocation method. Allocation type is just like the P&L. We're breaking it up between indirect and direct. Our CEO, our CFO, our IT, business development. These are people that might not be working with clients every day. They might be, but in this example, they're not, or it's too hard to figure out where they're spending their time and which client. So we're going to call them pooled resources. Everyone uses those employees to varying degrees, and we're going to simplify it. Instead of trying to figure out for any given month, how much did the CEO spend with each client, we're just going to spread these by revenue. So exactly the same as the P&L. Client A is 33% of revenue. So we're going to give client A 33% of the loaded comp, which you can see here's the 33%. Here's the loaded comp. If we multiply these two together, we get 83,000. That's what we're allocating to A. And it's the same exact formula for all of our indirect employees. Once we get to our direct employees, which are your account managers, supervisors, coders, billers, payment posting, data entry, anybody really focused on predominantly delivering services for your clients, we're calling them direct. And then here in our clients column, we're just assigning, okay, which clients are these folks working with? This coder, employee 11, works with one client, client C. This account manager is with clients A, D, and E. And we can split their times in various ways. And what methods you choose to split their time up and allocate your expenses is completely up to you. I would say this is where your PM reporting gets really helpful. If you have a good click analysis or time spent analysis, claim processing analysis, where you can look at this employee submitted 1,000 claims for this client this week and then 50 for this other client. Well, that tells you where they're spending their time, right? So I would heavily suggest you rely on as much reporting as you have and as much standard reporting, very little customization where you can to make this easier. For folks like account managers and supervisors, we often find it's hard to really determine from reporting where they're spending more time because, they're helping their teammates, right? And they might not be on their computer. They might be working on other people's or standing behind them and talking about it. So instead of trying to get too granular with them, we're just going to ask those employees, hey, account manager 7, of your time, how much do you spend with client A? How much do you spend with D? How much do you spend with E? In this case, they told us 80% client A and then 10% with the other two. So we'll take their $75,000 compensation and spread it accordingly. 60,000 going to client A here, which are dollars, and then 8,000 and 8,000. So we're breaking it out. And then same process down here, except instead of asking them for an estimate, we're going to use those productivity metrics. So coder 11 is actually 100% on client C. Coder 12 splits their time. So we're going to look at how much claim volume they're processing for each one of those clients, and we're going to allocate accordingly. Ultimately, what we get, and this will show up on the next slide, is these numbers in the bottom right. These numbers sum up all of the expenses above that we're allocating to each client. So as you can see, $632,000 of our payroll expenses are going to client A, and 368,000 are going to client B, and so on and so forth. So here's a summary. So instead of looking at a big table, we figure it's a little bit easier to digest if we break it down a little bit. So we got rid of all the client names here, and now we're just grouping it by indirect and direct. So what can we make of this? Client A, which is 33% of revenue, is using 37% of our payroll resources. So that's not unusual. Usually your big clients, you want to show them some love and give them some extra resources. So 4%, okay, we should note it, but that's not a glaring issue. Client B is only 18% of our direct resources, but they generate 23% of revenue. So maybe we're being more efficient here. Maybe those claims are larger than client A claims. There's a lot of different ways that could happen. So, as I mentioned at the beginning, the goal of this is, yes, to calculate your profitability by client, but also hopefully along the way through each of these steps, you can find little insights like this, like what are we doing for client B? Do we have a rock star manager there? Do we have different processes there? If so, should we share it with some of these other client teams? Or is this client just submitting cleaner codes and cleaner medical records with better notes? So your team has to spend less time going back and forth on document retrieval and clarifications, right? Some things you can't always help internally. You can train the client, but it's not as simple of a fix when you have to go to the client and train a doctor. But okay, so what do we get here? We have our total allocated payroll and benefits. So this is an input for our model. And then we also here calculated what's the percentage of each of these. So 35%, 20%, 24%. We're simply going to use that to calculate how we want to allocate our office rent. which logically, hopefully you can understand why that might make sense. So if client A is responsible for 35% of our staff, then they should be responsible for 35% of our office leaves, because if we didn't have client A, we could have less office, right? It's a little bit imperfect because I know leases have fixed periods and you can't always get out of them, but you know, it's an assumption that we have to make since we can't get around the fact that leases exist. So here you can see we plugged in our payroll and benefits numbers from that exercise, as well as our office and rent. So we've done all of this. We've calculated our allocations, and now we can finally calculate our net income. And I'll go to the next slide. It'll show basically just the same thing, but a more condensed summary version. So here's revenue, expenses between direct and indirect. And then we have our net income margin in this row. And then how much of the total net income does each client represent? That's what this last number is. So as we get into this, we can see client A is 33% of overall revenue, but they're only 20% of net income. So why is that? It's because they're running at a 9% margin. As you might recall, client A was very, very heavy on the offshore costs. They were over half of our offshore costs. So we should look at that and say, how can we improve this? Should we try to negotiate a lower fee with our offshore vendor, or clean up what we're sending to them? Client B is 36% of our net income. So client B and D are really our star clients. Even though they're less revenue, they're contributing more to net income. Each of them are. Here's 32% of our overall net incomes coming from client D and 36% from client B. So hopefully, you know, this is illustrating why in an M&A perspective, this exercise is useful, because as a buyer, 33% can represent a risk, right? If I come in and I acquire a company and they have a client that makes up 33% of revenue and we lose that client, that's a third of the business that goes away. But when we look at it from a net income basis, yes, it's still significant, but it's a fifth of the business instead of a third of the business. So the risk there is a little bit lower than we initially perceived if we only looked at the revenue percentage. On the flip side, client B and client D are much more important than they might originally seem. You know, combined, they make up 43% of our total revenue, which are significant clients, but, you know, not outrageously significant. But they make up 68% of our total net income. So if I'm a buyer, I'm saying, okay, I want to dig into these two relationships and I want to figure out, what are we doing with these clients? Are these two clients both in one specialty that yields better margins? If so, can we use that and direct business development resources there to keep targeting more clients like these? Because I think most business owners would rather have B and D than C or E, right? And ultimately, you know, you might go through this process and it might look something like this. The numbers might be much tighter with less variation between the two. Or, and this has happened with some of our clients in the past, they do this and they realize client A is just, or client B is 5% or 3% or 1%. And then you have a decision to make of how do we get that better? And if the client's, as Zach gave an example earlier, if the client's asking for a fee reduction, you know, you're already very close to break even with that client. Is it worth going down further? If you do want to keep the client, you know, what concessions can you get them to make? Can you start passing some costs through to them? Those types of things. So hopefully by doing this analysis, it shines a light on, you know, what tools do you have? What tools do you want to implement across your clients? And when it comes time to be in a competitive situation, either to get a new contract, to win your current client, or to get a better rate, you're armed with information and you know how much bandwidth you have to move before you start weighing on your overall profitability margins. So I think that's all we had planned. So we'll open up for questions if anybody has any.
Okay, thank you, Zach, so much. I'm sorry, Casey, thank you.
Yeah, that was all Casey.
Casey and Zach, thank you both. What I'm gonna say is if anyone has any questions, please put them in the Q&A chat. And you guys will be able to see them and answer them, and I could unmute you and you can answer a question. If you raise your hand, we could do that as well if you want to ask your question.
Yeah, and I know that was also a lot of content, so we're always happy to follow up after the presentation if something comes to you, as it often does after the fact. We're always happy to answer any questions you all have.
Okay, wonderful, great. Okay, I don't see any hands raised. Just gonna say that look out again. Do you want to put up your contact information so people know where to find you? Do you have that on a slide, guys?
We don't.
Okay.
But it should be pretty easy to find. Greenberg-advisors.com, or Casey and I are both on LinkedIn. Zach Eisenberg, Casey Krasko. Oh, we do have a question. I have been told by some PE shops that having a large client base, even if some are not very profitable, is still attractive given cross-sell opportunities that the buyer may leverage. Absolutely, that's absolutely true. More so, I mean, this would be more applicable to a strategic buyer than a private equity firm. But absolutely having a strong referenceable client base, that's built into i.e. Symmetry. Symmetry is actually a former client of ours. Yes, that's absolutely built into the deal economics, where you can come in and say, they look at the company and say, wow, look at their book of business. And you could either look at it from an offering perspective or a market perspective. Let's say an offering perspective. Let's say you strictly focus on insurance resolution, insurance follow-up, denials management, and the company that's acquiring you doesn't have any of that. If you've got a lot of denials management clients, that's going to be attractive because then they can sell their existing offerings into that client base.
Okay, great. Thank you. That was a great answer. I hope that answered your question. Anybody else? Okay, well, you know where to find Zach and Casey. Look out for emails from us regarding upcoming webinars. For those of you that registered for this and did not attend, you'll receive the recording. You'll all receive the recordings. If you want to watch us back, you certainly can. And thank you so much, guys. I truly appreciate you sharing your knowledge, sharing your wisdom, and appreciate you.
Thanks a lot for having us.
Okay. Have a great day, guys.
Take care.
Okay, bye. Bye, everybody.